Everyone tells you to use an RRSP for retirement savings in Canada, but no one talks about how taking the money out actually works. But I will, because after I spent 7 years as a wealth manager at one of Canada's biggest banks, I saw way too many people lose out simply because no one ever explained the RRSP withdrawal basics to them. So in today's video, I'm going to explain what an RRSP is, how the taxes work when you withdraw early, how to avoid those taxes, and what happens when you retire. Let's break it down. Your RRSP, the Registered Retirement Savings Plan, is a special account in Canada that allows you to invest your money and let it grow tax-free until you take it out. When you contribute inside the RRSP, the government gives you a tax deduction, which reduces your taxable income for the year, which is beautiful for savings. The catch, though, is once it's time for you to take the money out of the account, the taxman, the CRA, as Mandem's gonna come knocking on your door, he's gonna come asking for the money, basically. So keep this in mind. Anytime you withdraw from your RRSP, the financial institution that you have your RRSP at is going to take taxes off right off the bat. Anything less than $5,000, there's going to be a 10% withholding tax. Between $5,000 to $15,000 is a 20% withholding tax. Anything above $15,000 is a 30% withholding tax. For example, you want to withdraw $10,000 gross from your RRSP, you're actually going to end up with $8,000 net. Reason being that 20%, $2,000 is going to go to the CRA as a prepayment of taxes. Okay? But also, that withholding tax is not the final tax. Okay? When you file your taxes for the year, the amount that you withdrew is also going to be added to your taxable income. And so if you're in a higher tax bracket, you could end up owing more. If you're in a lower tax bracket, maybe you'll get some back. Think of it like a paycheck, okay? Anytime you will get paid, right? Taxes are taken off right away, but at the end of the year, you still have to file your taxes. Depending on your marginal tax rate, you could get some money back or you could end up owing more. So it's essentially treated almost like a paycheck added to your taxable income even after there's been tax taken off of it. Now here are two big exceptions where you can withdraw from your RRSP without having to pay taxes right away. First is the home buyer's plan. This allows you to withdraw up to $60,000 from your RRSP to purchase your first home in Canada. There's no taxes up front, you just have to make sure to pay the funds back within a 15-year period. Second is the lifelong learning plan. This allows you to withdraw up to $20,000 from your RRSP to go back to school. Again, no taxes up front, you just have to make sure to pay this money back within a 10-year period. In each instance, if you do not pay the money back, it does get added to your taxable income, the amount that you did not pay back. So just make sure you have a plan to pay it back as they require you to. So now let's talk about what happens in retirement. Because by December 31st of the year you turn 71, you have to close or convert your RRSP into something else. So here are two simple options that you have. First, which is the most commonly used one, is called the RRIF, the Registered Retirement Income Fund. And basically in this account, you are mandated to withdraw a minimum amount every year. This amount is set by the CRA and it's a percentage value of the whole account. Number two is an annuity, and this is basically an insurance product. So basically you give your RRSP funds to an insurance company and they guarantee you a certain dollar value every year until you die or whatever date that you choose based on your insurance details. And from that point on, all withdrawals are counted as taxable income. They're added to your income for taxes. Sad. But the idea is that you are now in a lower marginal tax rate, so ideally you'll be paying less taxes on the funds now than you would have been in retirement, and hopefully the savings that you made in your working years outweigh the cost that you're paying in your retirement years as taxes. You do have the option to convert your RRSP into a RRIF before you turn 71. All depends on your financial planning and your income situation, okay? Just keep in mind, December 31st of the year you turn 71 is the latest that you can make that conversion. So simply put, RRSP withdrawals are never free money. They are fully taxable, and if you withdraw too early, you could end up owing a ton of money to taxes. The key is creating a financial plan that allows you to plan accordingly for and how you withdraw this money so that you can end up getting the best deduction possible and saving the most from taxes later on, not owing too much. I hope this video was absolutely valuable to you. If you have more questions about RRSPs or Canadian investment accounts in general, I do have a Canadian investment guide that you can purchase on my website. The link to that is in the description below. And stay tuned for more Canadian investment videos by hitting the subscribe button and having yourself a beautiful day. Cheers.